Good afternoon, good morning, good evening, everyone. Welcome to the Virtual Banking 2.0. What's next for virtual banks in Asia? According to the report by Boston Consulting Group and Singapore FinTech Association in 2020, over the last 10 years, digital banks grew by 26% on a compounded basis. And over the last 5 years, increased by 200%. What is more interesting is that Asia Pacific digital banks is only 20% of that. What it means is that it has a lot more room to grow. So today we have 4 very esteemed speakers together with us to share with their experience on virtual banks in Asia. Before I start, let's share about the 3 driving forces of virtual banks in Asia. First, we have very favorable regulatory regimes created for virtual banks. Started off with Hong Kong, issued a virtual banking license, followed by Singapore, and Malaysia and Philippines will be issuing their digital banks this year, and Indonesia is stated to release their digital banking regime this year. Second, we have a very supportive market liberalization policies to further open up the financial markets in Asia, especially in Southeast Asia. Third, is the enhanced digital adoption of all things digital, including digital finance, very much helped by COVID-19. So without further ado, I would like to invite our esteemed panelists to give a quick introduction about themselves. Maybe I start with Greg from Tonic. Greg, over to you.
Thank you, Hoklai. Hi, everybody. I am the founder and CEO of Tonic. We're a digital bank in the Philippines. We've been operating publicly for 2 months now. Our product proposition is basically a full stack banking set, including the current account, various types of deposits, time deposits, stash deposit, group stash, and we're rolling out loans next month as well. So yeah, that's basically about us.
Thanks. Next, we have Melissa.
Hey, hi everyone. My name is Melissa. I'm currently the CFO of OI, a leading payment fintech in Indonesia. I'm also the director of Global Association of Risk Professional Indonesia chapter. A little bit about myself. Prior to joining OI, I contributed to DBS Indonesia as the head of credit risk and COO. And in total, I've accumulated more than 15 years of finance and banking experience, along with my previous tenure in JP Morgan and Citi Singapore. Other than that, I contribute as a lecturer of CFA classes in Indonesia Stock Exchange. So it's indeed my pleasure to be here today with you guys, and I hope I can share some perspective with everyone here. Back to you, Hoklai.
Thanks, Melissa. Next, we have Dennis.
Thank you very much. This is Dennis, CEO of Mox Bank in Hong Kong. We are a licensed bank in Hong Kong. We have been operational since September. Since September, we onboarded 2.3% of bankable population in Hong Kong. We have, a couple of, products, and we just launched, our credit card, in Hong Kong. What we are trying to do, we are trying to get, as much as customers, as many as customers, to Mox Bank, with the right products and services.
Okay, last but not least, let's have Michael.
Thanks, Hoklai. So I'm Managing Director of Vacuum Labs Asia. Vacuum Labs is a European-based developer and builder of software solutions for the financial services industry, where we help our clients solve their customer problems and build new things like digital banks, payment systems, and the like. My background is not in finance. I've actually started my career in computer chip design and software, and over the years I've been following the impact that digital and software has had on numerous industries, and now it's reaching the financial sector, which is very interesting.
Thank you, Michael. Okay, my first question for all the panelists: how are you seeing behavior changing? Maybe you start with Greg first.
Yeah, thanks, Hoklai. We're seeing actually a massive shift in the consumer behavior in the last year and a half, driven by COVID. And that's really helping propel, I think, digital banking all over the world. There's a shift in payments, which I think is being observable, and especially in the emerging markets where most of the payments were cash. And people increasingly don't want to do that, don't want to touch cash, don't even want to touch, have somebody touch their card. So moving towards contactless payments with a card. And there's also a very interesting movement on the deposit side. In most countries around the world, the deposit balances paradoxically have been going up, even though the times are fairly tough, and we're kind of bordering on this kind of recessionary environment in many countries last year. But people save up more, and the reason they save up more is because when times are tough, people want to make sure they have that cushion. So in the Philippines, for example, we've observed almost a 10% increase in deposits over the last 18 months in the banking system. And on top of that, we're seeing that the consumers are much more keen to make sure that their money is working hard. So that it's not just like making 0.1% per year, but they're actively looking for yield. And that's also helping the digital bank contenders, because typically digital banks like ourselves, we don't have the bank infrastructure to support, so we can offer better interest rates. And our interest rate right now is the top one in the Philippines. So that definitely helps as well. And the consumers, I think, deserve to be making money on their hard-earned money, and we're happy to help them do that.
Great. Basically, you are sharing that the consumers now prefer contactless. They are saving more, and they are chasing after you. Okay, over to you, Melissa.
Thanks, Oklai. I think what has changed a lot lately, right, in the banking landscape, I guess, is the evolving customer expectation. Aside from that, the internet user penetration has been one of the catalysts behind the substantial growth, of digital banking, which is very much accelerated by COVID-19 pandemic. I think we all realize, right, as the banking customers, we are no longer satisfied with just conventional products. Rather, we are more and more looking into having a seamless customer experience, from the ease of onboarding or account opening without the need to come to the branch, to having product reference that suits our needs. And also like value-added features like personal finance management, instant feedback features, and so forth. And during this pandemic, I guess we all have seen an increasing awareness from the customers to invest and also to insure themselves, right? As a result, as opposed to just plain vanilla products like deposit, credit card, loans, the demands for financial products such as investment in stocks, bonds, you name it, mutual funds, insurance, have increased substantially over the past months. Now, looking into Indonesia, right, the presence of digital banks here has been growing a lot. And the digital banks here are expected to be able to improve the accessibility to enter into the untapped segments such as underbanked and the unbanked population, which currently accounts for more than 75% of adults in Indonesia. So I guess the emergence of digital banks and neobanks altogether should be able to promote open banking collaboration among them and the incumbent banks in the ecosystem, which at the end of the day, it will lead to banking innovation and financial inclusion. Yeah.
Okay, thank you. You talk about increase in customer expectations. Next, I would like to hear from Dennis, because you are operating in a very different environment compared to Indonesia and the Philippines. So how's the customer banking behavior changing over in Hong Kong?
Yeah, thank you. So Hong Kong is a very crowded market in terms of financial institutions, but when you look at from outside, but what I believe that I would quite disagree. Why? Because you can have a lot of banks, you can have a lot of products in the market, but that doesn't mean that you have the right digital services end to end in that market. From digital service end to end standpoint, I don't believe that Hong Kong was quite mature. But of course, Hong Kong is extremely mature in terms of the products. So what we try to do in Hong Kong, we try to change this customer behavior a bit different. But of course, COVID also helped, because in Hong Kong, I think before COVID, people there was a mobile banking penetration in Hong Kong average around 50%. Of course, after COVID, this number is totally different. But again, there's a nuance that we have to understand. If you are talking about digital banks or digital services, we are not a channel. So customers, they don't want to consume channels anymore. They want to consume the services end to end. If it is a bank, channel is not a right strategy anymore. So this is the biggest mental change on the customer side. And we have to understand this as bankers. The second thing is, of course, after COVID, we saw more than 700,000 new e-commerce users. So these people, they had never used e-commerce before, but they are consuming, digitally right now, which also helps, banking as well. Why? Because they also, use all, banking services digitally. And on Mox side, what we did and what we tried actually, we changed, the service mentality, from product to service. Actually, Mox Bank is a service-led bank. It's not a product-led bank. And what we are trying to do here, if you want to onboard yourself, as you know, you can onboard in a couple of minutes. Literally in 3 minutes, you can open a bank account. And then you do not need to think about, okay, how am I going to deposit money? How am I going to save? Which tenor is the best for me? Which interest rate, should be okay for me? You do not need to think. Bring your money. There's a button there, add money, and then bring your money. Tomorrow morning, you will get, interest rate, 4 a.m. You just need to, think like this. Banking, shouldn't be that difficult. You shouldn't, think like, okay, cashback. How much cashback am I going to, get, at the end of this year, or am I going to, see in my next statement? It will come, 45 days later, and you have no idea how much you are getting and how you are going to redeem it. In Mox, you can get, cashback real time, and you can see in your account directly, and you can get interest rate tomorrow morning, from that, cashback as well. This is the change. This is the mental change that we are creating on the customer side. Why? Because the most important thing here is there is no saving. There is no spending. There is no card business. There is no deposit business, for the customers. There is only one business. They have their money that we have to manage, like, how they think.
Oh, wow. I mean, opening a bank account within 3 minutes without having to see a banker face to face. Later, I'll come back to you again. For Michael, I have a very different question for you, since you are a service provider to banks and virtual banks. So from your existing client base, right, what are the top focus areas for them? Is there a difference between incumbents and virtual banks?
I'd say yes. I mean, yes, I am a service provider. I'm also a customer of Mox. So everything that Dennis says, I've experienced it. When my daughter turned 18, the first thing I did is I gave her the phone and I said, install this app. And literally in 3 minutes, she had an active bank account. No branch visits, nothing. So.
And that is a Mox bank account, is it?
Yes, she chose Mox.
Okay.
So getting back, I think there are a number of trends that have been evolving. I mean, if you look also in other industries, as more and more of the world is becoming driven by software, I think that many of the tech specific, the institutions that begin from a tech mindset have a bit of an advantage because they are able to adapt to using software much more quickly because their mindset is different from sort of what I would call old school IT. So generally providing things like giving customers solutions, as Dennis said, as opposed to products which are been set in people's minds. You have a checking account, you have a deposit account, you have a mortgage. That product mindset is shifting, and we're seeing a lot of companies that we work with in the startup space as well, looking at finding ways to address customer solutions revolving around money. And we've seen this happen before. I mean, we've seen this in how retail has been changed through e-commerce. We've seen the entertainment industry completely change. And I think it comes down to giving customers choice. And customers have gotten used to the digital experience. They've gotten used to using apps, whether it's playing games or watching movies, anywhere, any place, anytime. And the sort of expectations have just been increasing. And I think it's important for the financial industry, whether it's a traditional bank, to not only adopt technology, but also change the mindset and the frame of reference in terms of what customers expect. So we're seeing that in Europe, we're seeing that in the US. We're seeing the ability to address very specific market needs that have not been necessarily well addressed before with the traditional approach.
Thanks, Michael. Okay, for Greg, Melissa, and Denise, I have this question for you because some of you have a digital banking license. Some of you partner with a bank to power some of your product lines. How important is a digital banking license? Maybe we start with Greg.
Sure. Well, in an emerging market, I think it's extremely important. Why? Because there are basically two monetization models that have emerged for digital banks, for neobanks worldwide. There's the current account model, which is being executed in the developed markets in Europe and the US, and that model relies on payments interchange specifically for monetization. There are various debates about whether that business model does give enough monetization or not, but at least in the developed market, people are used to using their cards, so you can monetize them. In an emerging market, you don't really have that possibility because people are not used to using their card at a merchant nearly as much. So you don't get the interchange. Most people will get their salary into their salary account and go to an ATM, take out cash and spend the cash, right? And okay, that's changing now with COVID, but not to the extent where you can monetize effectively off of that interchange your whole customer acquisition cost. So you need to lend. So basically the neobanks that have been successful and profitable in emerging markets, guys like Nubank in Brazil, Tinkoff in Russia, these guys are very, very profitable, but they're lenders funded with deposits, old school. Take deposits and lend it out. And that's how you make money, right? To execute that business model, you cannot do that on the back of somebody else's bank license because, most banks in their right mind will not allow you to leverage their compliance for taking customer deposits and then turn around and lend it out with, God knows what kind of credit risk. So that's why our first move was actually when, I started Tonic. We went to the Banco Central in the Philippines and we said, guys, this is what we want to do. How do we do this? We need a license for this. And we built a very, I think, outstanding relationship with the Banco Central, and that they understood two things: that financial inclusion in the Philippines is a massive problem. 70% of the people don't have bank accounts. That needs to be solved. And on the other hand, it's one of the most digitally native countries in the world. Average age 24. Number one Facebook country in terms of FaceTime. 4 hours per day on Facebook on average. Everybody's got smartphones. So they basically understood that this financial inclusion problem will be solved digitally, and we were able to achieve with them a sandbox regime where we had the first digital bank in the country running on the back of a rural bank license, but they made all the exceptions for us to make that possible as a purely digital business. So I think in an emerging market context, it's extremely important. And I'm very happy to see the regulators in the emerging markets wisening up to that.
Yeah, over to you, Melissa. How is it different in Indonesia?
Right. I think to me, what's more important than the license itself, right, is the actually the openness of the regulators to accommodate innovation and to have new solutions such as cloud-based core banking systems, as well as to have open communication channel through, let's say, dedicated offices or regulatory sandbox, right? Unlike in Hong Kong, Singapore, Korea, Taiwan, and some other countries, Indonesia does not currently issue digital banking license. So what we can observe lately in the landscape is actually the entrance to the banking sector through the acquisition of commercial banks that have already existing banking licenses. To name a few, we have Cbank, Bank Jago, Bank Neo Commerce adopting similar entrance approach to the market. On the regulatory side, we have seen the eagerness and the support from the regulators to welcome innovation through digital banks and neobanks alike. While we remain mindful of the risks, including customer data protection. Most fintech outside payment, right, are actually handled by OJK or Financial Services Authority. And those fintech outside payment must comply with the regulations for the non-bank institutions, but they can also enter into the market through the regulatory sandbox that allows innovation, from the new companies. If I recall correctly, back in November 2019, Bank Indonesia, as our central bank, has published the blueprint, the Payment System Blueprints 2025, which entails the reform programs in, their attempt to digitize the country's payment systems. So I would say overall, I do see a very conducive environment down here in Indonesia, even though we have no digital banking license, such that we can launch a wide array of innovation in the banking space, while also putting consumer data safety on top of mind. Definitely, yeah.
Okay, good. Then over to you, Dennis. You are operating in the developed market.
Yeah, thank you. So there are two different angles for digital banking license. First of all, we are backed by Standard Chartered, a big banking group, also backed by Hong Kong Telecom and Trip.com. And we wanted to, get this license. Why? Because the first reason was it's easy, to create, something like, you can create, some financial services, easily. But if you are talking about banking, the most important thing is not technology. The most important thing is not the product and services. The most important thing is trust. I've been in banking in the last 21 years. And if you want to talk about trust, and if you want to get the trust of your customers, that is quite it's the most valuable thing for you as a bank or as a financial institution. I think that license is quite important. And honestly, I'm not defining this entity, Mox Bank, like a neobank, challenger bank, digital bank, or whatever, however virtual bank. We are a new future operating model of Standard Chartered. And if you want create a future operating model backed by a bank, backed by a telecom company, then you have to get this kind of a license to create that operating model in a different way. Technologically, risk-wise, AML, FCC, marketing, culture, people, you have to define it. So that's why it was important for us. The digital banking license, it's important for the markets. This is the second angle. Why? Because, for example, today, we are talking to, Michael, and Michael, brought us, a lot of, talented developers, from different markets, to us, to build this. When you have, digital banking licenses or, new kind of, banking licenses in that market, it creates a huge ecosystem. So right now I'm working with, 5 RegTech companies, and without RegTech companies, you can't build a bank, right? I'm working, with a lot of, different FinTechs to run this new bank. So we are bringing a lot of, talents outside. We are, growing, our talent base in Hong Kong as well. So having a digital banking license in a market, it creates a huge boost, to create the right ecosystem in that market. So that's why, I don't want to look at this, only from my angle, also, from market space plus, ecosystem, it's super important.
Okay, thank you. You have a very interesting perspective. Basically, you are saying that by introducing a dedicated digital banking regime, it helps to catalyze the ecosystem to further develop. Okay, my next question is related to internationalization, because so far, I think 3 of you are not operating beyond your current market. Correct me if I'm wrong. So is expanding into multiple markets important to you? And if yes, right, which are the markets will be your priority and why? Maybe we start with Dennis.
Perfect. It's a great question. So we have a laser focus to Hong Kong, but if you are asking a quick answer, which market will be the next, I'm not going to answer like that. I mean, there are a lot of opportunities in this region. First of all, we should start from GBA, Greater Bay Area, right? So GBA has a huge potential for Hong Kong, because you can see you can almost see GBA area on my behind, right? It's easy to see, and this is quite reachable. And to be honest, there are a lot of potentials for more than 75 million people in GBA. And in Hong Kong, what we are doing, I think we are giving right services, and we will bring new services in the near future. But especially for GBA, I'm seeing a huge opportunity if we can connect Hong Kong market and GBA markets together. So my answer is mainly we have a laser focus to Hong Kong, but GBA has huge opportunity.
Okay, Melissa.
It's very good question, right? But I guess, the way we define our business strategy ultimately boils down to the company's vision, right? So for OI, we envision ourselves to be the major enabler in the country to democratize finance through having seamless money movement. And we also want to promote financial inclusion in Indonesia by serving the underbanked and the unbanked segment, including the micro, small, and medium enterprises. Currently, OI services cater to both B2C, covering users in almost every province in Indonesia, as well as B2B users across very diverse industries. So back to Hoklai's question, Indonesia will remain to be our core focus, and we will continue to be like that. And currently, we are looking into expanding our geographical coverage in Indonesia itself, and also improving our existing services through having diversified use cases. And for now, we are substantially expanding our bench strength and the team. So, we would really welcome all the bright talents from various domains to be part of our growth as well. Yeah.
Great. What about Greg?
Well, Philippines is a very large market, 111 million population. The consumer lending asset class right now in the Philippines is a puny $10 billion. So on a per capita basis, if you assume even just the convergence of the Philippines to Vietnam and Indonesia, which are at a similar level of GDP per capita, then we're talking about the asset class needs to expand to $40 to $50 billion. If we assume convergence further to the more advanced comparables here in Southeast Asia, to Malaysia, to Thailand, we're talking about over $100 billion worth of asset class that will be created in the coming years. We know the demand is there. We know the disposable income is going to be continuing to grow because it's a secular trend. So that's the vector. So for us, if you talk about unsecured consumer finance and you talk about, let's say, $100 billion asset class, that's a revenue opportunity of about $50 to $60 billion per year at the types of interest rates that are, normal and unsecured consumer finance in the marketplace. So, that type of revenue opportunity is going to keep us busy for a while. I think, we need to execute in the Philippines and then we kind of see what we do next. But, in the meantime, like the deposit market as well, it's $300 billion deposit market overall, out of which like half is retail deposits. So to finance that book, there's definitely plenty of juice. And if you can position yourself into that risk-adjusted spread, then we can build a very, very nicely attractive business on the strength of Philippines alone. And that's why we're very focused on that for the time being. I think the opportunity also exists in a similar one in Indonesia and Vietnam, but it is much more complicated there to achieve what we achieved in the Philippines in terms of licensing. And without a license, as I pointed out, my business is going to be not possible to build without having your own bank license. So Philippines will keep us busy for a while.
Okay. I have a question for Michael related to internationalization. I presume your client base cover globally. Which are the region or countries that you are seeing most demand now for your services?
Well, we primarily cover three regions. We cover Europe, which is where the company originated from about 10 years ago. We were expanding in the US and in Asia. We were seeing a lot of demand in Asia, but Europe, and I think now that what's happening in Europe and the US is as economies return more to normalcy because of the vaccination drives, we're seeing a big boost in demand both in Europe and the United States at the moment. Hong Kong, I think, and Asia in general, we didn't have this kind of everything stopped and then started picking up again like we had in other areas. So I wouldn't say it's a matter more of timing than any sort of long-term type of trends than anything else. So, interest in growth in Asia, where we were relatively late to enter. We began with Mox and a few crypto projects here, and then I joined the company last year to grow the business in Asia. So I'm certainly hoping that I'll be able to do some rapid growth, and we're getting quite a bit of interest here.
Okay, great. My next question will be related to profitability. How do you balance both growth and profitability? So basically, this question is obviously targeted at both all the three panelists, Greg, Melissa, and Dennis. Let's start with Melissa.
Yep, it's true indeed that nowadays we cannot just rely on rapid growth alone, right? But rather a solid business model focusing on profitability should be inside the minds of every fintech founder and management. We have to pay close attention to the product's unit economics and see how we can improve it as the business scales. And looking into the Indonesia's fintech sector, I would say it's in the growth mode. But regardless, many businesses have realized the importance of sustainable growth. In terms of the product, right, I believe each product that everyone here carry actually stands an equal chance to contribute to profitability. But after all, it comes back to the ability of the management, the founder, to analyze the unit economics and define ways to reduce the associated costs through automation and to improve revenue generation. In the case of OI, we have recorded impressive growth over the past years, and we have operating model that will enable us to have sustainable growth. The business that has recorded solid metrics shall be kept as our backbone while we keep innovating and scaling, by expanding our features and the use cases to respond to customers' needs. But ultimately, right, it comes back to the commitment from the top management to set the culture, whether it's just rapid growth or it's sustainable growth. For us, it's sustainable growth that has always been our focus. So achievement from each department in the company is closely monitored and discussed transparently to ensure alignment across the board.
Okay, for Greg, I know you just started operating for the last two months. I would like to hear your views on this question, and also when are you projected to break even?
Thanks, Clay. Yeah, look, I'm an atypical startupper. I spent the first 10 years of my career in leverage buyouts. So that teaches you, imprints EBITDA on your back and front, pretty heavily. So for me, any business only makes sense to do if you're planning to be profitable and relatively soon. That's why for me, consumer lending, it's actually a very interesting business from the profitability perspective if you do it right. Tinkoff, the Russian digital bank, one of the largest ones in the world today, they pulled in return on equity of something like 45% last year. And that's on the back of a high double-digit growth year on year in assets. Now, in consumer finance business, you have to understand that it's not the customer acquisition cost that is the heavy one, it's the risk cost. Because IFRS 9 requires you to book your reserves upfront when you've booked a loan. And effectively, the reserves for the full vintage need to be booked upfront. So the faster you grow your balance sheet, then more difficult it is for you mathematically to make net income. It doesn't mean that you're not profitable. It just means you're not net income profitable, but you are booking profitable business, and it's intertemporal kind of trade-off, right? That in the future you will make that money to compensate for the initial reserve that you put. So essentially, you can build a very profitable business in unsecured consumer finance. Our plan is to break even around year 3 after launch. Remains to be seen how quickly we can achieve that, and we will be pushing to achieve that as quickly as possible. Which I think in the Philippines, the dynamics of the market are such that it is potentially possible to do that because there's very, very little middle market unsecured consumer lending really going on. The banks are not touching anybody who doesn't have a credit history. So all these guys are either borrowing from friends and family or borrowing from the loan sharks. And so kind of mid-market, term lending of 6 to 24 months is generally fairly unavailable. So that means that we have the advantage of targeting some of the better clients within that universe and hopefully breaking even on the cost of risk pretty quickly.
Okay, over to Dennis. I think you have a very interesting consortium backing you, other than, I think, not just Standard Chartered or the telco. Perhaps you can share your perspective and how important is your consortium partner in your path to profitability?
Yeah, this question is my favorite question, and normally I answer it differently. This time I'm not going to share when will our break even come, okay? Because this is really, for me, it's not a fair question to a new fintech, new bank, new startup. Even if you if you set up a coffee shop, just around the corner, are you asking that, are you going to be profitable in 2 years' time? So this is a bank, right? You should think quite differently. Let me give a couple of things to you guys, and then we can decide what is important for these new companies, the new entities, new businesses. So as I said, I believe that new operating model is important, not being a mobile bank. So right now in MOX, we are operational. We have been operational like 7-8 months, and our employee to customer ratio is 1 to 550, which means one employee in MOX, he or she serves 550 customers. Okay, so this number will be more than 1,000 at the end of this year. My first question, because you asked me, when will your break-even come? I'm asking, do you know any bank, any traditional bank, that they serve more than 200 customers, with their one employee? This is my question, right? And you can't find easily. There are a couple of examples globally, but it is super, super rare. So this means if you have this kind of operating model, if you are scalable enough, and if you have the desirability there, and what is the meaning of desirability? Right now in Hong Kong, if you check App Store, Google Play, we have 4.8 stars on App Store, 4.6, 4.7 stars on Google Play. Have you ever seen a bank, with this kind of ratings, with more than 15,000 comments, positive or negative? We are the highest. I'm talking about entire financial institutions in Hong Kong. So if you have this desirability, if your customers they share their cards on social media without asking, if they are giving 5 stars without asking, if they are using their cards minimum 3 times every week, I'm talking about a debit card previously before credit card, and if you have an operating model like if you can serve more than 1,000 customers with your one employee, I think that should be enough answer for the future. We can always talk about 48 months or 5 years, 4 years break even. These are not important. I mean, I can also give the product roadmap, everything, but we should focus on this first.
Okay. My next question is for Michael. With the excitement and increase in the number of digital banking regulatory regimes in Asia, especially in Southeast Asia, right? So FinTechs and incumbents build their own capability or outsource to providers like you. What's your take on this?
I think you have to, I see it in a different way. First of all, to put it in context, the term outsourcing is, I think, a very antiquated term, and one of the things that we have to do and we try to do is get people to change a frame of reference. And the thing is, outsourcing really became a big thing 20 years ago. For those of you who remember Y2K, where you had big companies going out and outsourcing primarily to India to look for the code that might blow up when the year 2000 began. And 20 years ago, software was fundamentally different from what it is today. 20 years ago, it was monolithic. It was inside of an enterprise, whether it's a bank or in another institution. It was sourced from very, very large, very few number of very large vendors. If any of you have gone through an SAP transformation or an Oracle installation, I mean, it took years to develop. It was very slow. By the time it hit the users, it was usually a lot of change in the environments, and there are many, many stories about how that was not very satisfactory. And if you fast forward to where we are today, it's a completely different world in many, many ways. So first of all, it's not monolithic, it's modular. It's designed in small building blocks for different functions. It's not centralized, it's distributed. It doesn't come from a small number of vendors. You have to deal with, in some cases, hundreds of different suppliers, which also involves a change in the finance department when they come and say, why do you have so many vendors? Why are you dealing with so much? Because a lot of things arrive in terms of services, whether it's microservices or other types of serverless solutions that are available either from AWS or from many third parties. Simple things like sending a text message to validate goes through companies like Twilio. So the environment has fundamentally changed. And the other thing is the development methodology has gone from waterfall, which is you define and specify everything, to agile, where things are you figure it out as you go along. And when you combine all these factors, the important thing is to be able to attract the best talent that can work on that and source it from anywhere in the world. And we very often, with many of our clients, we work alongside directly with the clients, internal employees, as well as other companies like ours that provide talent as well. And it's a very different mode. So it's still the bank or it's still the enterprise that's developing. It's their software, but we allow them to tap into talent that we can then provide, that have the experience base that can add value to allow them to do what they need to do. So the bottom line here, it's all about the software. Software is the defining things. Andreessen said software is going to eat the world. Well, it has. It's all about software these days. And I think in that case, it's getting the right software developers that understand how modern software is developed to solve customer problems.
Thank you, Michael. I think we are running out of time. Perhaps I would like to take a question from the audience. Perhaps one or two of you could answer that. So basically, one of the questions is that do you think big tech companies like Grab, Google, and are a threat to virtual bank startups? And anyone would like to take that question?
I'm happy to take it. Yeah, the guys that are building super apps, one of the big areas they're trying to push into is finance. The most natural thing for them to do is payments, and what we're seeing is Grab and Gojek and the types. They got their wallet propositions running. To leverage that into loans and then especially deposits is not so easy, because I think Dennis hit it on the head that you need trust. Does the Grab brand really leverage itself into a deposit type of trust level where you would keep substantial wealth management chunk with them? I don't know. Can they finance a loan book without attracting deposits? Well, in the current super frothy market, they can attract wholesale finance of probably sufficient size to finance it for a while. But banking markets are cyclical. Long term, you need to have your own deposit book to really be able to sustainably have a lending business. So I think there are different payments, yes, loans maybe, deposits maybe with a big question mark.
Okay, thanks, Greg. Yeah, unfortunately, we ran out of time. Once again, the big round of applause to our fantastic panelists for a very insightful sharing. Thank you, everyone.
Thanks for having us.
Thank you very much.
Thank you for moderating, Hokai. Appreciate it.
Thanks.
Take care, everybody.